Initial public offerings or IPOs, for many investors think that's great. I can get in the ground floor of a company as it goes public and I can make a ton of money. And we'll find as we go through this, it might be harder to do that and actually to even make money. We got an example at the end of this lesson too, so stick around for that. I think you'll find it quite interesting. So first let's talk about, well, what is an initial public offering or IPO? Well, it's when a private company goes public, right? And by going public, that means it's listed on some type of stock exchange. It could be anywhere in the world, an established exchange like the Nikkei or the NASDAQ or the New York Stock Exchange or whatever. There's lots of stock exchanges. But private companies are not listed on those exchanges. Private companies are held by a smaller group or owners or maybe one person or partners, smaller group of insider, well, I don't say insider, but inside people who own the company, right? It's private. It's not publicly traded. I can't buy and sell stock in a private company. But a public company, I can buy and sell stock. And that's why companies go public, so they can buy and sell stock and be listed on the stock exchange to raise money and some other things to do around that. And we'll learn about that also in a second too. But first off, the understanding initial public offering or IPO, a private company is going public. It's going to be listed for the first time on a public exchange. And traditionally, it was only solid companies that went public, right? It was like, oh, we've been a private company, we've really grown, we're doing terrific. Now we can go public because we're well established and people will really value and buy our stock because we're an established private company. Traditionally, that's how it was, right? But then investing or trading is all about the future. So it's all about the future prospects of companies. I want to buy at a certain price with the hope that the future will be good for this company and I'll have some capital appreciation, maybe even some dividends along the way. But I'm looking towards that future growth. And that's what investing or trading is all about, is what does that future look like? And what is the first kind of mover advantage of some companies that might be larger or starting to go public within an industry? And it was always usually very, it's always speculative, but it was always kind of around these solid companies went private. And then the internet boom kind of happened. Well, more than kind of happened, I guess. And all of a sudden you had lots of companies going public that really had no establishment of facts or anything to really a leg to stand on as far as the quality of the company. Most of those companies actually were never had turned a profit. They were just kind of like, we've been borrowing money or getting venture capital in here, people investing in the company in a private manner. And then we would go public, and then we'd raise more money basically from the shareholders. I'm buying stock, and that initial stock sale goes into the company. And the idea when companies go public is they want to take the money that they have coming in from that initial sale before it's traded back and forth between folks like you and I. But that initial sale of stock, that's a big infusion of cash that goes in the company. And they use that, the idea is they use that to grow their organization. That's what you're looking for. So companies are going to take that money, invest in their company, and grow their organization. Maybe it's a retailer says, we've been doing great in this area of the country, but now we want to expand to the rest of the country. We want to expand worldwide, and we need money to make that happen. So we're going to go public. You might have heard the term going public. So we're going to take our private company and go public. So that's one big thing as far as an infusion of cash to invest and grow the organization. That's what we're really looking for. Now, there's also an element of the founders or the owners, the creators of the company, have now want to cash in. They want to have their own exit strategy, right? They've put all this blood, sweat, and tears in the company. They've grown it to something. Now they've gone public, and this is where they can really cash in and really receive a lot of money, not only to the company, but money that they can then take for themselves, that they can use basically to pay themselves. And for many, it's an exit strategy where they grow the company, and their whole idea is not to maybe even continue to run the company. They just want to get the infusion of cash, take their part, and then leave the company and turn it over to others to manage. So think of IPO as the initial offering of a company for the initial offering of stock, and you're trading on the future, and hopefully you're looking for companies that will grow and they're investing to grow, but there'll be some element of exit strategy or cashing out. Now there's a lot of internet, especially technology companies that might be smaller, and their whole goal of creating the company was to have an initial public offering and then raise a lot of cash for the founders, and then they cash out big time, and it's really not a sustainable company. Or it might grow to a point where maybe a larger company will buy them, they'll merge or acquire the company, and that's how they get their money too. So there might not really be much interest in growing the company long term, just a short-term gain. So you might want to watch out for those. And I was mentioning the internet boom. It was a real interesting thing because that's where it really turned in a great way during the early 2000s or in the 90s. That is, during the internet boom, where you saw these great valuations of companies, you saw stock prices really kind of booming, And you had companies like these internet companies, Pets.com is a famous one for that, and there's others out there too, where they really had never ever turned a profit. Their business model might be a little suspect. They couldn't even necessarily articulate it well. And what is the long-term prospects? But the money was growing so fast. We were really in a bubble, the internet bubble, the technology bubble, that you could almost launch any kind of company. And so if it was technology, internet-based, people are thinking, oh, this is the dawn of the internet. This is the birth of the internet. I want to get in and invest in these companies that are really speculative and hopefully ride that wave. Well, many rode that wave up, but then they rode that wave crashing on down too, because a lot of these companies had no real business plan, no real fundamentals. And so we survived that period. Well, of course, you survived that period, but think about that, especially when trading or the market's really rising, when you're looking at maybe these younger companies, what are their, what are their growth prospects? So how does it kind of work? So how does initial public offering or IPO work? Well, first off, you have an investment bank that manages it, right? There's called underwriters, and they kind of put it all together. They help, determine like the initial price that this initial public offering will be based on their experience, based on the market, based on a lot of factors. And companies pay big dollars to these big institutions to help them go public. And so they really rely on that. And then when it hits the market and it becomes public, we can buy. Now, the challenge is a lot of the insiders and folks that are tied to these big investment banks, they get kind of a first shot, an early shot before it really truly goes public. So we're not necessarily buying at that initial price. You've got owners or founders in the company. You might have employees of the company that own stock in that company, private stock, and you have institutional investors and big investors who might have a crack at getting that before it goes public. And there's some scandals around that too. And we'll talk about like Facebook. There's all sorts of scandals around, insiders getting in first before it really went to the general public, and some things that happened after that. Now, so since we're getting a little bit later, you can still buy a stock at its initial public offering price, and maybe it'll go up or maybe it'll go crashing down. The investors, the institutional underwriters or investment banks try to get an accurate price, but once it gets out there, it's a free market at that point, and so the price could go up or down. In fact, history shows initial public offerings, the prices will tend to go down, at least for a period of time. So if you're thinking, I'm going to buy an IPO because it's going to go up right away and then I'll cash in, be cautious of that. It's a very, very risky strategy to do. So especially early on, the price can be very volatile, going up and down as the price kind of settles. There's also what's called a lockup period, and that's very important to understand. It's typically 90 days. And what that means is that 90 days, that's when the insiders can sell. So if I'm Steve Jobs and I founded Apple with Wozniak and we went public, well, there's rules around that where I can't sell my actual stock, my private shares that are now turned into public shares and worth millions and maybe billions of dollars. I can't sell those until a 90-day waiting period or a 90-day mark, as far as that waiting period for those insiders to sell their stock. So they have to wait 90 days. So what does that mean for you or I as far as that 90-day mark? Well, think about it. The thing goes initially public offering, we can buy and sell, and then the days start counting down, and then when 90 days hit, what can happen is a lot of those insiders are now looking to capture what money they've got. They want to take their winnings. They want to take their earnings. Maybe they're a venture capitalist that put a lot of money into the private company. Now they want to get their big payout out. So what happens at 90 days is the stock price can really take a hit from an IPO. Potentially can take a hit because all those folks are exiting the market, and you have more sellers than buyers, and it causes the price to drop. So be aware of that 90-day mark. That might be a time, if you have a stock, to sell it before that. If you bought it on the open exchange, you're not an insider then. Or buying it after that 90-day mark too, and then you might have the price settling down a little bit, less volatility, and you'll have all those inside investors getting out, between that 90 to 100-day mark, and now you'll have a little bit more truer valuation of what might be happening with the stock. So that 90 days is real important. And really, the big thing I'd really caution folks is don't buy an initial public offering or something that's initially listed for its first day in the market just because it's an IPO. So many people get caught up in the behavioral economics of it or the emotion of it, like, oh, this great private company went public, I'm going to buy it now on its first day publicly trading as IPO. You might be excited about the company, but I would urge caution on that. Do your due diligence, do your research. Maybe you feel still real comfortable about it, but I know history shows it can be a risky thing. So just keep that in mind if you're looking at something that's just gone public as initial public offering. That doesn't mean it might not go public and go up from there forever. You know, I'm not making a recommendation one way or another. I am saying that history shows initial public offerings right when they go public are very volatile and can be real problematic. And certainly if you're a risk-averse investor, you know, these are much more risky things when you're getting early into initial public offering. Let's take a moment to look at one case study or one example I think you might find interesting around initial public offerings, and that's with Facebook.